Hello, everybody. For end of first quarter, so March 31st, 2023, we had decent close to the week, actually. Lots still going on in the world, of course. So, going to go through most of that today. We are wrapping the tax season here as well. So, been busy sending out a lot of tax slips, gain loss reports. We've had questions from the accountants a little bit because they get the T5008 and then they get the gain loss report. So the T5008 now actually gets uploaded to CRA's site. So that's a lot of the same information in the gain loss. But some accountants like to file the taxes, in a kind of a blended foreign exchange, so Canadian US. So we're happy to send along anything that you or your accountant needs just to finalize those taxes as we start to work through those here as well. So lots to cover. Because I'm by myself today, I'm going to jump into the presentation here and go over just some of the things that I've seen happen this week, and really kind of the top stories that we're going through here. So just apologize, bear with me. We're getting the screen share. All right. So I follow quite a few people on the research side of things. Certainly there is, for those of you that subscribe to Twitter, there's a whole kind of FinTwit, kind of financial Twitter that people paid a lot of attention to. And so I think last weekend we had a report on from CNN just talking about the fall of the US dollar, so to speak. And so that really steamrolled into the week. I mean, I've been talking about this for years, just about how and when that might potentially play out. But I think the CNN report kind of steamrolled and picked up speed. And there's just been an onslaught of information around what's happening to the US dollar and its hegemony and such. So just wanted to touch on a couple of things just to give you context for what that means, for where I think we are in that process, and some of the potential pros and cons of it happening. So if we look here, this is really the kind of the world breakdown of the currencies, just to give you context. Of course, the blue one certainly would be the US dollar. And so this is how most of the world trade is settled here. So if we look across the bottom, these are the periods of time that we're looking at, the 3-year segments for how much money is settled in the different currencies. So the US here, you have somewhere close to 90%. And you have, the remaining breakdown would be yen, sterling, won or renminbi, this is just the Chinese dollar, and then the euro. And so there's been quite a bit of attention just about what the Chinese have been doing with starting to settle some of their foreign exchange in won or renminbi, and with their relationship with Russia. Certainly, that's not a surprise. This has been in the works now for a couple of years. Seems like this is gaining a little bit of a rolling momentum. Saudi and Iran moved into a peace deal. Seems like they say that China was a part of making that happen. Saudi has looked at setting up an agreement with a couple of the African countries to settle in their local currencies outside of the US dollar system. I think these are all things that have eventually been coming and moving towards, but the likelihood that we go from overnight the US dollar stop being the world reserve currency, I think has a probability of about 0 right now. So I think it's certainly overblown. Yes, the US dollar will probably lose its status, and it's not necessarily going to be a terrible thing for the US. But at this present time, I think it's significantly overblown. And so if we look at a few things, and one of them, which I didn't put the chart up today, is Jim Bianco put out a chart that shows essentially what's happened to Chinese bonds in the last decade. And there has been net selling of Chinese bonds over the last decade for foreigners. So, until that the comfort and confidence in the bond or fixed income system in China starts to play out to the rest of the world, the likelihood of that being the world reserve currency is quite low. Ultimately, my view is still the same, which we're going to see a basket currency at some point in the future. I think we're moving towards that, not today, but I think that's the direction we're going, kind of primarily based on GDP and such, but we could discuss that another day. So this chart, if you look at it here, it really shows the kind of what's happened since the US dollar has achieved reserve currency status, and just really lots of history around why. However, if we look at what's happened since the start of the petrodollar, which is essentially the world agreement to settle everything in US dollars, particularly oil contracts, and what's happened to, we'll say, the average American since then, and you've seen massive productivity increases, of course, and you've seen compensation certainly not keep up with those productivity increases. And so there's a pretty material argument to be made that it's actually been detrimental for the average US individual. So certainly what and how this is going to play out, I think will be interesting for them. From a market perspective, obviously material consequences if the US dollar is to lose its status, but I think we're certainly way far away from that happening immediately. Certainly it's a tail risk, but nothing that I think we need to be worried about today. Is the argument if we look at as well, so what's happened to trade in the world. And if you look at the year 2000, the US was the major trading partner for the rest of the world. And if we look at what's happened since 2000, we've seen the rise of the Chinese economy. And so their objective has always, I believe anyways, is to be the world dominant major economic superpower. And so over the last 20 years, they have been taking one country at a time and kind of moving out. And if you look at what this means, 20 years is a long time, but in the great scheme of things, it's a small time and a short time. And so the Chinese country and economy has been really grabbing and becoming the major trading partner with the majority of the world right now. And they continue to move in that direction. So what does this mean? I think a lot of things, something we could discuss another day. I don't think it's a risk to the US dollar immediately, but ultimately, I think we're moving into that position where we need to think about the major implications if it continues to happen this way. The thing I thought I'd just take a quick look at is we look at just the composition of returns. So we look at Canadian markets and US markets. And so oftentimes you may have seen these kind of scatter diagrams, but as we just end Q1, I thought it'd be worthwhile to take a look at, see how things have, like where the returns have come from in the first year or in the first quarter here. And we have the TSX up a couple of percent. We have the S&P up a few more than that, so 3 or 4%, where TSX is probably only about +2 in the quarter. And so if we look at what's led throughout the quarter here, we started with software, and so they finished out the quarter on a pretty positive note, somewhere around +20. Then we had healthcare had a pretty good quarter as well. Pharma was quite volatile, finishes the year or the quarter out on a positive note. And if we look at how these things did into year end, the things that have bounced the most were the things that were down the most last year. Similar composition if we look at the S&P 500. So if we look at what did well out of the gate here, we had autos with a pretty good start out of the first couple of months ending last year. So autos had a challenging mid-year, and so those bounced back pretty strongly. And then tech and hardware had a pretty good rally in the first quarter of the S&P. So we can continue to see how this is going to play out. I think as we came into the end of the quarter here, there's quite a few markups as you're getting portfolios being rebalanced for positioning. You had pretty light volume the last few days as well. I'd expect the volumes today to be light too. We won't see that until it closes up here. But certainly we had a bit of a markup into quarter end, and we'll continue to watch and see from there. So thanks I had a client that sent this report along. As I've been talking, certainly in my dailies and certainly in the weeklies when we do this, just about really kind of the risks in the system. And so we've seen with the U.S. financial system, seeing rising rates put a lot of pressure on things. And so we saw that first pressure on the financial system, regional banks. We had money come out of their one side of their portfolio. They're having challenging sell of their bonds, losing money on their bonds. They didn't have enough capital to pay back the depositors. So we've seen that happening. In another perspective, we're starting to see delinquencies pick up. And so I've been talking about this for about a month now, where we've started to see them kick up. And so if we look at this, of course, we see auto loan delinquencies kicking up. We see credit card delinquencies kicking up. For the first time in a long time, we've seen mortgage delinquencies kicking up as well. And so I think if you look at the Canadian data, this is US data, you would see similar numbers. And so again, lots of questions about where are rates going. And my view, it continues to be that we've seen the high in rates in Canada. US, we'll see. The data is a little bit mixed. I think we've seen the high in rates in Canada, and this data continues to point in that direction. So just do two more quick updates on Hedgeye, just from a positioning perspective, how I think from a strategic perspective, and then an update on what's happening with growth and inflation. Has anything changed this quarter that would make me change my view on where we are in the cycle? And so this one I've pointed at before, but this is effectively CFTC non-commercial net long positioning. I mean, it's a long-winded answer to say these are how non-hedgers are positioned. And so why this is relevant is it gives you an idea, really kind of positioning, how are people positioned in portfolios. The one thing that I always like to look at is that my view continues to be that we're in the early stages of recession, which means that how are people positioned from a bond perspective? Because if we're in a recession or heading towards one, then bonds should tend to do quite well. And how are these people positioned for that? And so, for example, here, if we look at this particular one, this is the US 10-year. And so the latest positioning is a net negative 517,000 contracts. And then we look over to the minimum and maximum for the last 3 years. What's that been? So we've been kind of max long 238,000 contracts here. And then we've been minimum short 607,000 contracts. So really what that means to me when I look at it is the market's not positioned for bond yields to go down and bond prices to go up. And so if we get a momentum move where that starts to happen, is yields are falling and prices are rising, you could see a pretty material repositioning as this moves from kind of a net negative 517,000 to maybe a more neutral positioning. That would provide significant lift in the US 10-year as an example. Part of why I put this chart out here today, though, is because this is showing Canadian dollar versus US dollar. Again, similar, we look at it, look at what's and how is Canada US positioned today. And so we look at it here, we're at negative 59,726,000. The number doesn't matter. When we look at it from a perspective of what's that mean from a min-max positioning, this is the max short. We've seen this positioned in the last 3 years. And so what that means is that the Canadian dollar is overbought, US dollar oversold versus the Canadian. We've had oil soft the last couple of days. So when you think tactically, what is likely to happen coming out of this is you get a material move up in the US dollar versus the Canadian. Again, these are just strategy things that I thought were relevant to talk about because I tend to get questions about these types of things quite often. So have had a bit of time today just by myself to give you a quick update. And then, of course, the last one that we'll touch on is what's happening in the market. And has anything changed to change my view, which is I think that GDP and inflation is slowing. And so again, this is a scatter plot. You can look at what really it means. There's the 4 quadrants, which we've talked about before, which is growth. So quad one is growth is accelerating and inflation is decelerating. So I think that's where we're heading, probably the back half of this year, but we're not there today. And then quad two is growth is accelerating and inflation is accelerating. So that's a different backdrop. I don't think we see that set up this year, maybe into 2024, but that's a long way off. And then if we look at quad three, which is growth slowing and inflation accelerating, can be argued that we're in a brief period of that, a stagflation type period. I don't think we're there today. I think we had some stagflationary data, but I don't think that's where we are today. And then the last one, which would be growth, it'd be decelerating, inflation would be decelerating. And so that's effectively where I think we should be positioned with that as the backdrop. And then over in the section that we're looking at here in the top right-hand corner of this chart, so we look at what's the expectation for the next 2 quarters of GDP. And so the next 2 quarters in US GDP is -2 and -2 effectively. So that's the forecast that Hedgeye has for the next 2 quarters of data. Obviously, this stuff happens in the lag. The market tends to bottom before all of these things. However, nothing's changed from a perspective of what's happening with the GDP data in the US, the same within Canada. So then we look at, has anything changed from a CPI or inflation perspective? And so we're coming in at a level here. It looked like Q1 data has inflation down to 5.88%, heading towards 4%. And then we'll see what the next 2 quarters look like. That continue to look like a deceleration in inflation. And so, yes, the absolute level continues to stay elevated. However, the market tends to care about the rate of change of that number. And so, say nothing has materially changed from growth continues to slow, inflation continues to slow. The longer rates stay elevated, the quicker those things come down. So I don't think anything's changed from that perspective. So that is it from a slide perspective. If anyone has any questions, certainly let me know. However, we are continue to work through any of the tax stuff that you need or have. Any questions, certainly give us a call. We continue to work hard getting all that information out to you. So do please let us know. Otherwise, we'll be back here next Friday, and look forward to seeing you all then. Hope everyone has a great weekend. Thanks so much. Take care, everybody.